Right now, we've got a whole bunch of Fed activity that's going on, of which we have news this week.
We have all this apprehension over tax hikes.
We've got Evergrande, which seems to be all over the news. All of this is taking place at one time. And from my perspective, I think it's creating a lack of clarity.
If you look at the news reports, it sounds like this Evergrande issue has been driving absolutely everything. When in every likelihood, this is not even a systemic financial problem for China. It will slow China's economy. It will be felt by exporters around the world and will be part of the slowdown in growth. But it's not going to be a systemic level event for the world by any means.
We're looking at the China slowdown as part of this larger slowdown that's taken place after the incredible burst of energy in the global economy after the pandemic is now coming to an end.
The International Monetary Fund's forecast for China's GDP is sub 5% by the end of the next 5 years. But what does it mean? It's still a very powerful, big part of the world economy. It's going to be an investment factor. Whether you invest in Chinese A shares or ADRs or whatever it may be, this is going to be a powerful influence on investing, period.
You've got to look beyond China, Fed tapering, government policy in Washington, D.C., and look out to what's going on. The world's willingness to tolerate COVID as an impediment to life is actually abating at a very, very fast rate. So you combine people's behaviors returning to normal, the actual vaccination rates going up, and you can see that the economic impact is abating. What's going on now is real GDP increases that have gone well beyond where they were in December of 2019. And that fact, the fact that the economy is now bigger, right, than it was then, having gone through this pandemic, is pretty extraordinary, right, Stephen? And kind of an important fact for all of us to keep in mind when we talk about growth, the idea that we're going to grow through this, we in fact already have.
Slower growth, not having a depressed economy to rebound from, but compounding our growth is just very natural, and it's going to be fine. It's just not going to be the kind of return environment that we just had from the lows of the crisis.
Growth is sort of endemic to the nature of the system. We have growing populations. We've got the use of technology. We've got incredible efficiencies that technology allows in the utilization of labor and the manufacture of goods.
In every economic recovery since 1960, save one, we've had double-digit earnings growth, a slower growth rate, but a positive growth rate for EPS above 10% in the second year of an economic recovery. And that is going to drive returns.
This is a time to view the coming out of COVID as a mid-cycle. That is, we've gotten all of the early growth out of this recovery. We're now at mid-cycle. We're now having slower growth, but sustainable growth, we think, for the next couple of years.
The most cyclical sectors can pick up sharply during that rebound from a depressed economy. But then the more defensive sectors pick up and outperform after.
What we want to do is rotate portfolios, to move from cyclical shares to higher quality shares, to move into the dividend shares that we've talked about in what we're writing, to move into healthcare, to move into, by the way, some foreign equities.
If we have less than a 10% EPS growth rate next year, it won't be dramatically less.